I'm Richard Winch, Executive Director of Startup Virginia. And today we're getting real about something every founder needs to understand. How capital actually flows, who's getting it, and why the old rules don't apply anymore. This session was recorded live at the Big Dipper Innovation Summit, created by JMI, where leaders in business, culture, and technology come together to explore the ideas and industries shaping what's next. This is Capital Catalyst, Pathway to Funding Growth. Jeff Beck, CEO and co-founder of Answers Now, guides his candid conversation with 3 investors who are changing the game. Sue Kim, managing partner and CIO at Standard General, who manages billions in alternative investments. Calvin Butts Jr., general partner at East Chop Capital, who's bringing institutional capital to founders everywhere else overlooks. And Aurelia Flores, director of Virginia Invest, who's deploying state resources to accelerate homegrown innovation. What you'll hear is the new playbook for getting funded, straight from the people writing the checks.
All right, are we live? Awesome. Good to see everybody. Panelists, thanks so much for being here. My name is Jeff Beck. I co-founded a company called Answers Now. We started right here in Richmond. We've raised about $25 million in venture capital to date. And I'm incredibly excited to dig in with our 3 panelists here because I know very little about their world of investing. So I'm going to just go down the line. So I'll let you kick it off. Tell everybody a little bit about yourself, and we'll go from there.
Thank you, Jeff. My name is Sue Kim, and I'm the managing partner of an investment manager called Standard General based in New York. And we do distressed and turnaround investing. So we get quite involved in the companies that we ultimately identify, invest in, and also help operate out of trouble. So I'm actually a generalist by trade, but probably the 2 industries that I spend the most time in are media and gaming. So I'm the chairman of Bally's Corporation, which is now a sort of a mid-sized gaming company. Nice to meet you all.
Calvin L. Butts Jr., general partner at East Chop Capital. Our firm was founded in 2018, primarily a focus on real estate and angel investing. We operate the world's largest minority-owned luxury vacation home company that's minority-owned. We have luxury Airbnbs from Martha's Vineyard down to Orlando, as far west as Texas and Tennessee, with several stops in between, Oklahoma, Virginia Beach, and the likes. We also do a lot of angel investing. We're the largest minority investors at Uncle Nearest. So we have a minority stake in a up-and-coming MLB Next Pro minor league team in Connecticut. We do a lot of SPVs, which are special purpose vehicles, where we provide folks who look like us and opportunities to get involved in private markets and alternative investing. And so that's been kind of a new phenomenon lately of Black accredited investors participating in these private market deals. And we've been facilitating that through our SPVs and giving folks a very unique opportunity to join in the wealth building race.
Hi, everyone. Aurelia Flores. I run the Fund of Funds program for Virginia Innovation Partnership Corporation. So what that means is that I run a program that allows us to be a limited partner in funds like these 2 gentlemen run. So we're investing in those funds and then making returns off of their smart choices, ideally. VIPC also does direct investing and has done direct investing for about 20 years. So for me, at least, it's a fun way to see both sides of the equation, both as a limited partner and as a functional general partner as well.
I would assume that we have both investors and entrepreneurs in the room today. So I'd love it, any of you can jump in, but I'd love to learn a little bit more about, 1, how you find your deals, kind of like deal flow, and then 2, how you find folks who invest in your funds. Like, how do you find your investors? Because 2 very different processes that go along with that.
So I can start. So our fund, traditionally, we went door to door. When we launched, we were buying, my partner and I, Carrington Carter, were building our first house in the Poconos as partners. And folks were kind of asking us, hey, you guys are buying these luxury vacation homes. Your families are enjoying them. Sounds like you guys are making good money. How can we invest in or with you? And instead of doing individual deals, we launched a private equity firm and said we would raise capital, we would pick the homes, manage the homes, and then our investors would own the homes with us. They would have access to them if they were open or available. And that's how we launched our first fund. It was an extremely successful idea for folks to learn the vacation rental home space, follow us and kind of use our performers and our spreadsheets to then go on and build their own vacation homes and start their own wealth journey directly under their own family operated LLC. And so most of our investors were friends, families, fraternity brothers, college friends. I think we have over 300 plus investors in our firm, and 60% are probably HBCU grads just because of our network. 23% are women, and we have really have done a really good job just kind of cultivating the neighbors, the friends, the fraternity, sorority, brothers and sisters of our network, and getting them involved in this by leading by example, putting our money to use first. We did not get much institutional support until our second fund. We received funding from two Black banks, Liberty Bank and Carver State Bank in Savannah, Georgia. Liberty Bank is out of New Orleans. And they came in as investors in our second fund, as well as banking partners and helping us purchase some of our real estate. So for us, the access to capital has not been easy. We had a great model and have had great returns. We were very new to the private equity space, and we were doing our best to try to get into some of the institutions and family offices. But as others can attest, it's about track record, longevity, relationships. And so now we have that, and we're having interesting conversations, but getting started was not easy.
I'm very familiar with the sensation of capital being difficult to get in the venture world. The no's they definitely outweigh the yeses. Can you talk a little bit about how it's changed for you all? Brand new, unproven, what those no's look like, how some of the, have you converted any of those to yeses, kind of how you've cultivated that network and been able to grow the fund?
You want me to? Okay, so I've been in the managing other people's money business for actually close to 30 years. I started right out of college working for Bankers Trust in New York, and so for 9 years I worked for others. So I got to see how they did it. How obviously I was on the investment side, but I got to see how frankly, when you run an investment manager, as important as the investing side is actually the outreach and communication side, where you're actually telling people, what you're doing with their capital, how quote unquote smart that is, mm-hmm. and why they should be also entrusting their capital with you. So, look, so I did that for 9 years for others. Built up a reputation for making money for folks, or being able to make money from money. And so when I finally left that situation, I actually wasn't really sure what I was going to do, but actually people were, like institutional managers were coming to me and saying, hey, we heard that you were the guy that made all the money. Here's some money. What would you, let's go. And so that's actually how I got started, with my own firm. I don't know, it's like 18 years ago. Mm-hmm. So I was sort of fortunate for having built up a reputation. But when it comes to money, let me just remind people how money works. And all this I've learned through the school of hard knocks. It's not like of course, I didn't have any relatives to teach me. My grandfather, a farmer in Korea, by the way. So it wasn't like this was passed down. But I've learned. I'm an observer. When it comes to money, there's only first of all, money decisions are not made logically. They're made emotionally. So never forget that. Never forget that when it comes to money, there's only emotion. There's not logic. And the two emotions, do we know what the two emotions around money are? Passion, not quite. Fear. What's the other one? Greed. That's exactly right. Fear and greed. And you could be passionate about fear or greed, but passion might be greed, But really, there's only two emotions when it comes to money: greed, fear. Greed, fear. And so, when you talk to people about making money, you have to give off greed, and not give off greed as in like I'm a greedy person. No. That'll create fear in other people's hearts. You have to give off in other people's hearts that by associating with you, that's the greediest thing they can do. And that's literally the whole game, you know, and it's, you know, are you able to convince people that you are the greedy play? And by the way, if you can't, then it's like fear. Because if you start talking about money and they don't feel greed, they feel fear, you know? And so a lot of the challenges of starting is because, hey, have you done this before? Fear. Oh, well, I did this apartment. I just doubled my money. Oh, great, you know? And you go through this journey with folks, and it's the same thing with venture capital. I don't do venture capital, but it's the same journey. There's only money, right? So there's only one kind of money. It doesn't matter if it's venture money or distressed debt money or whatever money there is. It's just only one kind of money. And so I'll stop in 10 seconds. If you're projecting your new business, if people have to walk away and be like, I got to get in that, you know, because that's the greediest thing I can do. If they walk away with like a lot of uncertainty, they're not sure about you, they're not sure about your idea, they're not sure about, you know, your team or your prospects or whatever else, it's not going to work out. So it's a battle between fear and greed, would be my only advice.
From the venture side, a piece of really good advice that's very similar that I got was, you know, we're getting ready to raise our Series A, and I was talking to another founder who had just closed his A, and I was like, what's the holy grail? How'd you do it? And he said, fundraise when you feel the best about your business. And I think that plays into your greed comment, because then you portray this confidence that is very authentic when talking to an investor. I'd love to hear your thoughts on how you all kind of manage that, both from your LP base and then also with your deal flow.
Yeah, so many things to say about all of that, but I do love that structure, even if I might put some nuance on it. But I think that's right, that people really want to contribute and then get something back, right? So if you're investing, even if you're an impact investor, which I am, in a lot of different ways. And by impact investing, I don't mean that I'm not making decisions financial first, right? So we're a financial first impact investor. Financial first on the VIPC side, that we're investing in funds that I believe can return the fund, and then some, but also with an impact on the greater Virginia ecosystem. So we're investing in fund managers that are going to invest in Virginia companies. So I have to believe they can do that. On the Citrine side, same thing. We're looking at women founders of some sort. So I have to believe that they're going to return my money as an angel investor, and that I think that they're going to be a great manager as a woman. But interestingly, a lot of times, I think maybe back to the greed side, we're also looking for white space, right? So where is there opportunity that others are not seeing that I can get in on? So if I'm looking at fund managers that might be investing heavily in, let's say, New York and Silicon Valley, I want to say, hey, there's an opportunity to come to Virginia. You're going to get first look at a lot of deal flow you might not otherwise have been looking at. The valuations are going to be perhaps a little bit lower, and the returns can be just as good or perhaps better than other places, because you're going to have some of those trade-offs. So you asked about how we find deal flow. Interestingly, because of my position as an LP, we're often out doing outreach to funds. So these two gentlemen, I said, tell me about your fund. What do you do? And because we're always kind of looking for fund managers as well.
Yeah, and I would say for my LP base, about 50% of my LPs have not made a private market or alternative investment. So they're, you know, in public markets. They may own their own home and may have dibbled and dabbled in some real estate. But for a lot of times, we were putting their first PPM in front of them, or their first, you know, investment opportunity in front of them. And, you know, there was a lot of fear, as you mentioned, a lot of fear. So to switch them from fear to greed, I mean, I had to almost show a super winner mentality, right? So I had to go and show them that I'm buying luxury assets and lakes, beaches, mountains, resorts. All right, if you didn't get that, then come and stay with me. So come to one of the houses. we'll do a weekend of introductions and kind of networking, and we'll hang out. You get a chance to see some of the neighbors, see the neighborhood. Now they're starting to think, okay, wow, this is something I want to be associated with it, as he mentioned, that green part. But then that wasn't enough. Then it was like, okay, well, what type of return? So I had to show that in my personal homes that the returns are X, right? What am I doing with that? So then it became, making big donations to my university, or, putting a boat on Martha's Vineyard, or, buying nice sports cars. And then it was, getting folks to want to be a part of something that had never invested before was very difficult. I had to show them a super winner mentality, let them touch and feel assets that I was utilizing, to build wealth and to become more interesting, which led to more deal flow. And this kind of piggybacks off the deal flow conversation. Getting in rooms and being a part of conversations and exposing yourself. And so I got started. I made my first investment when I was 25, a small medical device company. And I became addicted to investing. Because that led to a small investment into a small medical device company, led to me sitting with the Priskers, hearing about their investments, their fund, their family office. And I immediately just wanted to make enough money to start my own family office so I could just invest it all and just let that multiply into more and more deal flow. So one of the things we do at East Job Capital is Karen and I lead with our own capital. So we put a lot of capital out first, and then we vet the deal, and then we decide whether we're going to bring other LPs along or we're going to open up to our LP network. So deal flow for us comes through, speaking engagements, being in rooms, sitting next to other individuals, learning about what they have going on, asking questions, and also investing in other funds. I invested in Alexis Ohanian's 776 fund. He in turn invested in our fund. And then now we have the opportunity to invest in all of his portcos, which is a very unique and successful portfolio of companies all over the world. So, sometimes you kind of got to get in rooms and do things and raise your hand and, and getting rid of that fear aspect and, just wanting to get in the game to get started is a big way of finding deal flow for us.
You all brought me to the next question. I don't think anything personifies the fear, greed more than the public markets right now. I think it was fear Monday. I think today's greed. Tomorrow might be fear or greed. We don't know yet. How do you all manage your LPs and also your decision making along with a pretty volatile public market and kind of macroeconomic environment?
So there's really like the thing about so I grew up in New York, right? And I immigrated here in 1980, and so I guess I lived in New York when it was a lot rougher, but also lived in New York during like the great crash, and that was the funny thing is like you would read about it and you would see it on TV a little bit, and then you'd walk out and it's like, your friends are still riding bikes and you're hanging out and like you're still eating. And it's like, well, what is that? And so, and I lived through that myself. I joined Wall Street in, I guess it was 97. So I've been through a crash in 98, 2002, 2008. Like, it's like, it's every so often there's a crash. And the one thing I've, over time, I would say I observed is that like, there's like a finance world and then there's like a real world. And there's like a bit of a transition between the two, and sometimes one impacts the other. So like in 2008, I would say the finance crash really did impact the real world. Actually, unemployment went from like 4 to like 11%. And so that was like a really bad thing. But right now, like, okay, the stock market goes down. Unemployment's the same, it's like, it's okay, right? Everything, the sun comes up and it's like a nice day outside. And so I try to keep that perspective that, just because a whole bunch of rich people are losing money on a mark-to-market basis, it doesn't mean that the world is bad. It doesn't mean anything. It doesn't mean the world is good or the world is bad. Now the real world is different. The companies that make money and earn, and so I think about my own portfolio. And for example, in the gaming business, I get, because we own the company and we control the company, we get numbers weekly, daily, monthly. And so we had a great March. March was great, And so I guess like everyone's like, oh, the sky is falling. And I'm like, I'm looking at the numbers. I'm like, the March is good. The ends are meeting. This is a good thing. So I just think that there's just that perspective of like a hyper reality. Like sometimes Wall Street is like a hyper reality, so much hyper that it's actually not real. And then there's the actual world. People have to work. And what I would just say is the things I look out for is consumer health, unemployment, inflation, probably the two most important things. And frankly, right now, unemployment is low and inflation is actually relatively low. So that's pretty good, actually. So anyway, so I think that the current world is not so bad relative to the volatility that you see in the markets. But
Yeah, I would agree with that. I mean, we've our LP base, like I said, most of them are making some of their first out of public market investments. So when things happen, we'll get a couple calls like, "I need my money back," and I'm like, "Well, this is an 8-year fund locked up. We bought a bunch of real estate. Like, you can't just get your money back." But we've had to educate, right? So I mean, and that's just been part of kind of the Lord's work that me and my partner like to do, because educating our network, our peers, on making these type of investments, how they work, how you exit them, when you exit them. It's just about exposing them to really how investing works, period. And it's been a kind of a labor of love on one hand. On the other hand, now we have folks who are now committed to investing because they've seen returns. They've learned the waves of how it works. And what helped us was we were we're a hard asset. So our first two funds were luxury real estate. So, you go back to 1800s, anything near a lake, beach, or a mountain is still very popular, still doing very well, and likely has appreciated since that time. So, we were able to constantly remind folks we're in the luxury real estate space. This is traditionally going to do well. And we now have monetized the assets because we rent them out. We turn them into almost commercial-like properties. So, it's about education and letting folks, this isn't an app ideal in the back of a napkin. I mean, we invested in those too, but this is different. And so I think a lot of it's just education.
I want to take it from an institutional perspective just a little bit, because I think it might help folks who are thinking about raising, which is that the macro environment is still the macro environment, right? So you all know that M&A activity, people that are buying companies had slowed down quite a bit. The IPO market has slowed down quite a bit. So all of that trickles down into LPs that haven't received their money back. Now, if you're an LP in a fund, you're not expecting to get your money back in less than 10 years. So it is a long-term asset class, and you are expecting to get your money back in 10 years. So you're probably going to reinvest that money somewhere. And if those funds are not returning the money in a shorter time frame, then it just means that your money is a little bit more stagnant. The other piece of that, right, is that institutional investors also have a different composition of how they're thinking about their capital. They're putting a certain amount of money in the private markets. They're putting a certain amount of money in the public markets. They're putting a certain amount of money in real estate, private credit, all of these different things that are happening. And so the asset allocation that they're looking at differs depending on what's happening in some of the public markets. And I think it's absolutely correct what Sue said, which is that there's the financial markets, which we live in, and then there's day-to-day life, right? Everybody wakes up, still eats breakfast, still goes to the gym, does all the things that they're going to do anyway. So not to get too caught up in that. And if you're raising capital, it helps to know what's happening in the broader markets. I will say that our fund managers and fund managers in general have taken a much, much, much longer time to raise a fund in the last 4 years or so, 2.5 years, definitely, than they did before. And so as an LP, I need to know what's happening in the markets, how long it's taking to raise a fund, when are they going to start investing, when is that investment period really going to end, are they going to ask for extensions, what's going to happen there, when am I going to get my capital back? And all of those behind the scenes things absolutely impact when people are raising capital, because we're seeing fund managers, for example, deploying a lot slower than they were, let's say, in 2021.
Yep. Well said.
We've seen that too.
Yeah, let me add one more thing. Sorry.
Yeah.
So one of the things I always tell people to do is just focus on what you can control. You can't control the markets or things going up and down, but you can control what you can control. So, for example, if we're helping manage a company, or then we can do a good job, finding properties, finding renters, and all, that you can control.
Yep.
And so, in a time where there's a lot of things going on, you have to actually be more laser focused about what you can control. And you have to separate out everything that you can't control, and don't worry about it, because no matter what happens, you can't control it. Yeah, but the thing that you want to spend your focus on are the things that by focusing on it, you can actually potentially get a better outcome. I'll just give one last piece of sort of like historical context. Like, remember, speaking of market crashes, like the 99 to 2001, whatever, the big internet boom,
.com bubble. Yeah.
They're like, oh, everyone's like swears off of tech investing, horrible. That's when like Google and Facebook were invented, and if the people that were inventing Google or investing in and inventing and running and making it great for Google and Facebook were just like swearing off of all like tech because of what happened in 99, then those people missed out. And obviously the people that were focused on building those businesses didn't stop their focus. So, it's like the sports analogy, like focus on your game, your at bat, your down. Don't worry about the scoreboard, and don't worry about even the scoreboard in your game, because you can't control anything but what you can do. And definitely don't look at the scoreboard of the other game.
Can't.
Don't worry about that. Like, oh, I'll make the playoffs if these 4 people lose. Forget that. Make it whatever you can do. You do what you can do.
Yeah, I think Warren Buffett says, be greedy when others are fearful, be fearful when others are greedy. To use his 2 emotional points, there's opportunities when you hear fear and you see fear. You got to look at it differently. Cup glass, cup full, half empty. You got to approach a lot of stuff like that and try to look at it from both sides as well.
Let me say 2 more things about that, which is the business fundamentals are always the business fundamentals. I think people forgot it during the dot-com boom and bust. People forget it during, other points of the market cycles. But business fundamentals are always business fundamentals. So that is one thing you can control for your own business, number one. And number 2, I want to make sure that I don't go into any room or be on any stage where I don't invite people into being an investor in the private market.
It's true.
Because most people don't have access to those kinds of deals, and they are those markets tend to do very well over time. It's why institutional investors invest in private markets, and way too many people aren't invited into those rooms, right? It's part of why I helped to co-found a group of women investing in women, because women are not often asked, hey, come be an angel investor, right? BIPOC people are often not asked, hey, come be an angel investor, whether that means investing in a single deal, investing in a fund, hey, jump in, the water is warm, back to that greed and fear, don't miss out, because there is something here. I mean, don't put all of your retirement into an asset class that you're not familiar with, but get to know different asset classes, and really, if you're not invited in, elbow your way into those rooms.
Coming up, how these investors really evaluate founders and the fund structures opening doors that used to be locked.
Entrepreneur on the stage. I hear everything you're saying. Got it. But how do you maintain a level head if the business is built on Medicaid? We have no idea. I mean, you can see, it's rhetoric. We don't know. The sun still comes up, markets or whatever, but that still matters. Tariffs. If I'm a goods company, I've got a friend who runs a makeup company. Like, that matters. We don't know. There's no, it's yes today, no tomorrow. So as an entrepreneur trying to pitch you all their business that could potentially be impacted by Medicaid, by tariffs, by the hundreds of other things that are part of rhetoric that are hot air that we have no idea where it's going to land, how does that impact your views of fear versus greed when looking at these businesses that could be impacted or may not?
But
What do you think, really?
sure, you want me to?
I just talked.
Oh, okay, so yeah, so again, I try to keep some level of perspective when there's like general unease. You have to make the probably correct assumption that everybody is facing a general unease, and so no one's advantaged relative to that market condition. And so if you can keep your wits about you and take advantage of that uncertainty, that's just a great thing. So let me give you an example. So Bally's now has 19 casinos, and we're buying 3 more in Australia, so it'll be 22 at the end of that. And, I don't know, by some measures, we're probably the 3rd largest gaming company in America. We owned like 4 casinos in 2017. So we've been just sort of opportunistic, but one of the greatest opportunities was COVID closure. When in 2020, casinos, which never closed, by the way, had to close. So we had this interesting perspective where we operated a casino in Rhode Island, which was the first casino to close in America. Because our governor was like, we're closing, we're going to keep it safe, So, which is interesting because Wednesday she said, no, we're going to keep it open, we need the money. And then Friday she's like, we're closing them, And so nothing out of our control. So we have to actually run to Home Depot to get chains for the doors, because guess what? The doors didn't have locks.
Never closed.
They never closed.
Never closed.
Christmas Day, 2:00 in the morning, you go. Yeah, Easter, whatever, like the casino's there for you. And so we had to chain the doors because, and so now we're closed. And then everybody during that time, this panic set in across the entire industry. Holy cow, we have a business that depends on people sitting next to each other. Like no one's ever going to come, And for varying reasons, I disagreed with that thesis. I said, well, that's just not true, not the least of which, having this diversified portfolio, we had a casino open in Mississippi that actually was the first casino to reopen. So we reopened in like 6 weeks. We were open the week before Memorial Day 2020.
Okay.
And I remember when that governor said, hey, you guys can open, I remember being like, is this a good idea? Sure. This is probably a really bad idea. But we said, okay, I'm the chairman, right? So I was like, okay, so we are not going to mandate people to come back to work. We're just going to volunteer. If you want to come back to work, well, we will open it if we get enough people to open at the casino. And crazy enough, like 75% of people want to come back to work. That was a surprise to me. But again, this is one of the things where you could think reality, but everyone's reality is different. So 75% of people come back to work. It's insane. The first day we opened, it's triple the business we've ever had. Part of that was because everything else is closed, right? Remember the government said you could stay open Walmart, Target, and McDonald's, but if you ran like the health food store across the street, you had to close. Clearly unsafe, right? So we just happened to be in a business that was allowed to reopen relatively quickly because, frankly, the states need the money. And I remember I was like, holy crap. Like, this is and so I was able to answer that question that other people weren't answering. Will people come back to these tight and closed spaces? And so during that time, we ended up buying 10 of the 10 casinos being sold in America. So I went from like 5 casinos to 15 casinos in less than 12 months because other people had to sell their businesses because they're like, oh, we're running out of money. Like, oh, I better sell now because people might not come back. We might stay closed for, forever. And I'm like, and luckily I had the perspective of say, thank God for Mississippi. And so that we were able to take advantage of an opportunity that affected everyone. We had that perspective, and we got lucky, and I guess we had a clear head to go through it. And what I just say is, look, if you keep your head when everyone else is losing their head, that's a pretty strong thing. So,
yeah, and we were able to do something very similar, just to kind of give you the same kind of story with COVID. So, being in the luxury rental home space and competing against hotels, when COVID hit, a lot of hotels were getting similar situations, they were shutting down. People were scared to go in public places, public elevators. So here we are looking at an opportunity because we have large homes, private driveways, private yards, private back porches, front porches. People had space. They had to be, mixed in with strangers. And so we saw an opportunity, but, our LP base was like, the world's going to shut down. Hotels are shutting down. Y'all going to have to shut down. But to his point, these resorts, these communities need revenue. They need the tax base. And in the Southeast, where things were a little bit more lax, for lack of better words, we were able to operate most of our homes. But what we learned from it, and this is what I want to talk about. So when you have these situations, there's a lesson there. So what we did, we looked at the U.S. map and looked at the drivable population. So when planes were, getting, less, there was less plane operation, less flying around the country. We looked for where would people go if they could drive in less than a day. So that's maybe 1 or 2 bathroom stops at best. So we thought, families were really planning like this. My family planned like this. Everyone else was like, well, we want to go somewhere, but we can't be stopping at every, McDonald's and every rest stop, because of COVID. So how do we get to where we're going to go? So we looked at unique locations like Gatlinburg, Tennessee, which is drivable from 71% of the U.S. population. And we doubled down there. We bought more houses there. So, you can strategically find opportunities in these situations where there's kind of uncertainty and there's hesitancy. And we just looked at it as a new data point that we didn't think about until folks started driving more. And we bought opportunistically in places like Tennessee and Oklahoma because it was drivable from a lot of the U.S. population versus flights.
I think to your point, there's always going to be things that we just don't know what's going to happen, whether it's tariffs or, interest rates or whatever it might be. But what's important is to figure out what business you're in. So in venture, we invest in ideally companies that are solving, get up in the morning problem. Do you get up in the morning and you are worried about this problem? You're willing to pay for this problem. So even if the money doesn't come from one place, it'll come from someplace else because it's a get up in the morning problem, right? If you're solving problems for folks that don't necessarily have a get up in the morning problem, I don't have to go to a vacation home. But we do know that over time, people have gone to vacation homes. There is a highly affluent class right now that's spending a lot of money. It's, a third, 2/3 of the U.S. economy is built on that population. So if you're looking at the markets writ large and you know that your business is going to serve people where they are, give them what they need when they need it, and you're diversifying where your sales channels are coming from, you're going to probably be able to navigate some of those things that you just asked about.
We're getting some terrific questions from the audience. There'll be a QR code that comes around, so feel free to hit that and shoot them over. There are 2 that are somewhat intertwined. How does someone or a business owner get involved in investing? And kind of part 2 to that is there's a push from Congress to change the definition of an accredited investor. We're talking about this backstage. So can you guys talk a little bit about, how much money does it take to get started? How do you get started? And your thoughts around what Congress is talking about with the accredited investor minimum?
So I'll just start with the first one about how to get invested. So when I launched my first company, which was in healthcare space, medical communication, a company, I was trying to get grants from big companies like Pfizer and Novartis, Eli Lilly. And I was going to do these video programs. And I was like, okay, I got to go out and find all this talent for medical writing, video production, camera equipment. And that's really why I first started thinking about investing. I was like, if I buy the equipment, I own it, or if I partner or buy a company that does this, then I can control my costs, I control my margins, my access, my availability to ship. So as an entrepreneur, I always thought about buying the businesses that I needed as vendors and bringing them under one operation. And it's interesting now because that's all we think about now with our houses. It's like, we should own this HVAC company because we are paying them way too much money. We should own the plumbing company. We should own, the landscaping company because we look at it as investing in our own business because we can control it. We control pricing, we can control, whether it's scheduling. A lot of the biggest issues we have being successful is just getting vendors on site, getting things done, getting things accomplished. The more you control that, the easier it is to operate. And so one of the mindsets of an investor or entrepreneur should be to look at the other dynamics of your business. How can you control them? Or how can you partner with them? And if you can own them, even better. That's where I would start if I was running a business.
But the question is how to get involved in investing.
How much money does it take to start? And then, well, kind of part two to that is Congress.
So I would say for anybody who wants to learn about angel investing, find your local angel group or talk to people who are in your local angel group. Heidi, who did the introduction for us, is part of a local angel group, so you can go find her and ask her about the angel group. If that's something you want to learn about, there's a boot camp called Making of a Black Angel that's run by Eiffel for folks who are interested in investing with other Black investors, for example. So there's a lot of different places you can find to learn about investing in different asset classes. And the more you're in those groups, the more you'll find, oh, and these people also invest in private credit, and oh, these people also invest in commercial real estate, et cetera, et cetera. So to add to your, and invest in what you need to and what's tangential to your platform already.
I think you asked how much, right? So the answer is always it depends. I mean, we've had investments as low as $5K into Broadway plays and opportunities like that. We've had investments in the millions for real estate and for other funds and things like that. But it just, different firms will have access to different thresholds. And then the accredited investor question, yes. I mean, I think Congress is talking about some unique changes to make investing more accessible for others. But as of now, those of you that are aware, to be an investor in firms like ours, you have to at least be an accredited investor. And then there's multiple levels of that depending on your type of investment and type of opportunity available. But individually, your income needs to be around $250K. Combined with your spouse needs to be about $300. Or you have to have $1 million net worth. Exclusive of your primary residence. So that's the standard dynamic.
Or you can get certified. I think it's Series 7 or 65.
You can get your Series 7 or 5 license, and then that gives you the level of comfort and knowledge to evaluate. And that's just to help with risk. I mean, eventually these laws were to protect folks from getting somebody knocking on their door, telling them to buy this stock and be a part of this company, and it was some parameters in place so that folks couldn't get scammed out of their life savings. So the idea is so that you have a knowledge base of success and savings to protect you from bad investments, because as we know, a lot of investments do go to zero.
What are some kind of risk mitigation strategies that you all deploy when considering an investment opportunity? So you've got your investor hat on. Yeah, how do you mitigate risk? Play the public markets?
Well, I mean, it's about diversification. I mean, I could just say that's probably the easiest answer. It's just, if you're going to be in a bunch of real estate, you need to have some tech. If you're going to be a bunch of tech, you should have some real estate. Because, depending on the markets, the industry, and how things turn quick, fast, slow, you want to make sure you have something that's doing well and in different sectors or verticals. We like real estate, tech, healthcare, some media, to provide us with balance, right? Now, inside those sectors, we look at diversifications geographically, right? So our real estate can't all be on the Florida Panhandle because of hurricanes, right? We can't be stuck in the Midwest due to tornadoes and floods, et cetera. So we look at diversification in our own sector of different things, and even in healthcare, right? Looking at different disease states, hoping, to have a balance across what are very, very focused healthcare issues today.
There's probably the most important risk management tool is getting in right or buying right. Most businesses can be sort of reduced down to a stream of cash flows. This is how much this will make. It could be, going down steadily. Maybe it's up and down every so often, or maybe it will grow in the future. This is much more relevant for the kind of investing I do, which is, really established companies, but ones that are not doing great, like troubled companies that are turnarounds, not as relevant for angel or venture companies, which obviously the cash flow is negative for a long time and hopefully goes up in the future. So maybe my risk management when it comes to venture is don't do it. So I invest in cash flow. So I look to see what the cash flow is of a business and try to pay the right amount for it. Don't overpay for it. If you think the business is going to decline at a 10% rate, forever, and that means it goes to zero in let's say 7.5 years, then let's pay like 4 years worth of cash flow, because obviously you want to leave yourself a little bit of margin for error, that it accelerates or goes. So you want to get your money back. You want to put your money in and get it all out, 4 years or a quarter of your money out every year, and probably higher in the early years just to see if you can get your money out. The other way is sometimes a business has asset value away from the cash flow. So maybe if there's a business that's in a building, it's making a little money, that business, even if it were to fail, then you could take that building and resell it, relet it, redevelop it, and it's worth more or some other recovery value. And so having those two things in mind, what's your downside in terms of your asset values? What's your sort of, what kind of discounts do you put on the business that you see in place, the cash flow stream? Buying that correctly is your number one risk management strategy. If you overpay for something, you'd be the best hedger, trader, diversifier. It won't help you with that. You have to pay right on the first one.
Yep.
Good add.
I mean, I think I'll say, don't invest in super high risky things that you can't afford to lose your money, right? I think people have said that. But when you are starting to invest in asset classes that you don't know that much about, invest in what you do know, right? So, for example, my first several angel investments were in, I invested in a baby food company when my daughter was 2, for example. Boy, did I know baby food at that point, right? I didn't invest in biotech. We're starting to look at biotech funds, and I am pulling in people who know about BioLife and BioLife funds, biotech, and all of the different, nuances of that. Now I know the difference between therapeutics and diagnostics, but I don't know that I did a couple of years ago. So get people around you that know what they're doing and ask them questions.
Let me add one thing. Because this is sort of a general investing. Again, I don't do venture or growth investing.
You're missing out.
I must be missing out. But I invest in just businesses, basic businesses, and I'll tell you one observation. If you're trying to make a living, then just make a living. I think people get worked up about, okay, this is how I'm going to make my money, and it's going to be something cool. I think a lot of things where you can make money is not cool, and you could separate those two things. And so I'll give you an example of some of I don't know if you guys know, like the largest hotel owners in America is the extended Patel clan. Are you guys aware of that? Like, so these are Indian immigrants that came from I think Gujarati, and they're sort of all related, but they're not all. I mean, maybe I'm not 100% sure. But the way that this group figured this industry out was pretty amazing. They would find these like kind of busted, Holiday Inn motels and stuff that weren't working because as labor rates went up and you have to pay your manager and all the people. There was just very little money coming out of these things, right? So the businesses were willing to sell these things for sort of cents on the dollar in terms of replacement value, because as a hotel, you're making, let's say you're making like $50,000. So maybe you can buy one for $250,000, $300,000. But then these families would just literally move in, okay? And they didn't have much money. They actually didn't have much money. Maybe they pooled their community resources together and bought this thing for $250,000. Then they moved in. Okay, and they fired the manager, they fired the housekeeper, they fired the everybody, And literally the kids were going around like making beds and picking up and you know, somebody was just sitting at the front desk 24 hours and checking, giving you your key and taking your money. And so the $300,000 of labor that this thing had was gone. So these people were trading their labor for capital. Yep. And so all of a sudden now people looked at this thing and said, wow, you took this thing that was making $250,000 maybe, I'm sorry, $50,000, and now it's making $350,000. Now you're actually missing the fact that these guys are all sitting there all day long, you know, trading their labor for, you know, literally, you know, turning over the bedding and you know, cleaning the pool and stuff like that. Mm-hmm. But you know, you just rinse and repeat this very unsexy model, like, and now they own, I think, like a third of the hotel rooms in America, and there's like multiple billionaires, like God knows how many millionaires. This is doing something that nobody else wanted to do. Okay, trading, not having capital, not being super smart, having to come up with the best idea. Oh, I'm going to come up with frugal. You know, like you're better than Google. It's like one letter forward or backward, you know? No, you don't need to come, you know, you don't need to be a tech genius. You just need to be able to work really hard, find something that actually makes sense. You know it, and do it. Everyone else knows it, and do it. You do it, and you just lay into it all in, and you forget about anything else that's not in your control. People are like, "Wow, you're doing your own laundry." I'm like, "Goddamn right, I'm doing the laundry," you know. And every time I do the laundry, I'm saving like $20 from somebody else doing the laundry. Yeah. Just keep adding the nickels up. And all of a sudden, again, you took this thing that was making $50,000 for some investment fund, and you're making $350. And then the bank sees that and says, whoa, we like that. Yeah. I'm going to lend you, you know, like, I'm going to lend you $1 million.
Yeah, go do it again.
And then literally you bought this thing for $250, so now you can buy 4 of them. Mm-hmm. You see how that math works? Yeah, it's the math. You can literally do this with no money. You just have to, you know, you have to have willpower. And that's like no small feat in America. Like so many of us these days have no willpower. And you have to be willing to apply yourself, and you have to just strip away everything what you think is cool or sexy or a great idea, and just say, this makes money. I know how to make money doing this, and I will trade my labor for capital, and just grind. And hopefully do it with a few friends, because it's hard to do it. And you could do extended family. That's how it worked, because again, doing it alone is impossible. Like literally, you can't wash the sheets and sit at the front desk. So they went in as families, and now they dominate the hotel industry in America. It's just an amazing story.
Great story.
Nobody ever talks about.
That's a great story.
You know? It's not sexy, but it's real.
There's a really good podcast, The Sweaty Startup, and all he does is talk about these types of businesses. He's got a Twitter handle. It's really interesting. We've only got about 5 minutes left, so a little bit of a speed round. Do you have something you want to add to it?
I'm just going to add to that, I mean, there are plenty of people now that are looking at entrepreneurship through acquisition, right? So they're looking at companies that are already making revenue of $1 million and doing something like that, right? Which is like, okay, I don't need to start something from scratch. I can buy a business that's already cash flowing, and I can build business on that.
American Acquired is a good place.
Private equity calls them boring businesses now.
So you're gonna get off this. You're gonna go buy the HVAC company right after this panel's over. It's old. So we've got a couple minutes left. I want to wrap with a fairly straightforward question, but take it any way you want. Where should folks here go to better understand the business of investing?
So I'll just jump in. So it's funny you mentioned a bunch of podcasts. The podcasts are great these days. There's so many of them. And it's so amazing. Like, if you think about one of the limitations of, there used to be so many barriers to entry into these businesses. Like, because again, if your uncle didn't work at Merrill Lynch and you couldn't hang out at the country club, you just didn't know what business was. Right. Like, my only exposure to business growing up in Queens was I went to Manhattan I had to go an hour and a half to high school every day, but I would see these folks wearing suits and carrying attachés and stuff and be like, I don't know what these guys are doing, but I want to do that.
I like it. Yeah.
I want to do that. I don't want to go, because I grew up in the outer boroughs, went to like an immigrant church, it was greengrocers and fishmongers. And I was like, that's great business. And like, again, I have no, you could scale that too. But I was like, that was like, I don't know what it was. So I had the fortune of growing up in Manhattan, riding the subways and near enough to Wall Street to get a sense of what that was and want it, and then I could start reading the books, like, Wall Street books and stuff. I read every single one I could find. And then, like that's what I was able to sort of actuate. But nowadays it's so much easier because there are so many amazing podcasts out there where these founders, these starters that have already done the work for that actually, there's a series, I think it's a guy named David Senra called Founders. They're like a sort of an hour long, and he just basically summarizes biographies of interesting people he finds interesting. Now, I read a lot of biographies, actually. It's actually one of the most interesting things that I can do because, I don't know, I just like to read biographies. It's amazing to read the story of these people that passed and that, it almost has always the same story. But anyway, you can get that in an hour podcast now. You don't even have to spend time, the 12 hours that it would dedicate to read like, a regular biography. You can now listen to an hour long podcast and pick which one you want to listen to. That's just one way to do it. Anyway.
Yeah, and so I would answer the question. I would say the best way to learn about investing is to just invest. Like, you have to get started. You have to make your first investment. You have to ask a bunch of questions. Obviously don't invest anything that your life savings or, too much that you're not scared to really lose or get back a lot of it. But to get started and to ask the right questions, especially if you're going to invest, and be able to learn how updates are shared, how formulas are created, how the reports are put together, all the analytics behind the investment. That's how you're going to get your feet wet and you're going to become, more confident in your next investment. Because now hey, this didn't work, how it worked, what do I like about it, what don't I like about it. I could pick at any of my investments, but I learned from every single one of them. Some of them were great, some of them were absolutely horrible. But even the horrible ones taught me the most. So I know what to look for. Like when you start talking about cash flow, burn rate, and you start identifying habits and triggers from founders that are going to lead to bad moves and mistakes because you've seen it before. It's how you get in the game and become more knowledgeable. So to me, the key word is exposure. The quickest way you can expose yourself to investing, whether you make your first investment or you find yourself in the country clubs or whatever, listening. I found great investments sitting in a lunch break room in corporate America when I was in my 20s, listening to two guys talk about some investment. And I just happened to ask them, hey, what are you guys talking about? Is there room for me to invest? And I was able to get in for like $5K. This is back when I was 20. And, I was scraping together $5K, borrowing it from friends, saying, hey, I got this great opportunity. So you can find opportunities to kind of jump into this world. Just have to do it, by exposure.
Podcasts, YouTube, X, LinkedIn, read as much as you can, listen to as much as you can, and then there's nothing like doing it.
I like doing it.
Awesome. Thanks so much to our panelists and to the organizers and hosts, and thanks for everybody for their thoughtful questions, and have a great rest of your day.
Here's the truth. Capital isn't just money, it's belief backed by resources. And today's conversation showed us that the smartest investors aren't just cutting checks. They're building ecosystems where companies actually succeed. From creative fund structures to value-driven investing, these leaders are rewriting who gets to build wealth. The takeaway for founders? The capital exists, but you need to understand how these investors think, what risks they actually take, and how to position yourself as the opportunity they can't pass up. Be sure to check out our other resources and tools from Big Dipper Innovation so you can help shape what's next.